Welcome back to Gold Rush Reporter. I'm your silver analyst, and today we need to talk about something that's quietly robbing you while pretending to protect your wealth. When you hand over your silver and gold to big institutions like BlackRock and JP Morgan, you're not investing. You're literally paying them to manipulate the price of your own metal. You're paying them to keep your assets undervalued. These giants charge around 60 basis points in management fees, about 0.6%, just so they can control your metal through their paper ETFs like SLV. And it gets worse. SLV currently has a short position of 81 million shares. That's not regular trading activity. That's deliberate price suppression. Veteran analyst Ed Steer calls it gruesome, and he's absolutely right. People think owning SLV or GLD means they actually own silver or gold. They don't. What they really own is a promise. A piece of paper saying someone, somewhere, might hold that metal on their behalf. But those metals aren't sitting safely in a vault waiting for you. They're being leased out, traded, shorted, and used as collateral in a system designed to keep prices low. You're trusting Wall Street with your wealth, and in return, they use your metal against you. They call it diversification, but in reality, it's dependency. And that dependency is destroying returns for anyone still following those outdated rules. Andy Schectman, one of the most respected analysts in the precious metals world, warns that by investing in paper metals, you're feeding the same system that's suppressing you. Every time you buy an ETF, instead of holding real bullion, you're giving power to the institutions that want to make physical ownership more difficult. It's a loop that keeps the public trapped, while insiders profit from the imbalance. That old 60-40 portfolio model, 60% stocks, 40% bonds, is dead. Inflation has destroyed it. The correlation between assets is broken. Bonds no longer hedge risk, they multiply it. Diversifying by asset class doesn't work anymore. You have to diversify by risk itself. That means holding assets that can withstand inflation, monetary decay, and systemic failure. Physical metals, not paper IOUs. The fiat system is decaying from within. The same banks that created this financial mess are now quietly hoarding the very metals they once dismissed as outdated. That should tell you everything. They're preparing for what's coming while the public is distracted by yield-chasing traps. So ask yourself, why keep trusting the fox to guard the henhouse? If you've been holding SLV or GLD thinking it's the same as silver or gold, it's time to rethink everything. Leave a comment and tell me, do you hold physical metal or just paper promises? Central banks and sovereign funds across the globe are quietly making moves that most mainstream investors aren't paying attention to. They're not talking about it on CNBC or Bloomberg, but it's happening in real time. The world's biggest holders of wealth are demanding their gold back. We've seen more than 40 central banks pull their reserves from the Bank of England and the New York Federal Reserve. That's not some symbolic gesture. It's a message. Trust in Western financial custodians is evaporating. You don't recall this kind of repatriation wave unless confidence has collapsed. The official excuse is always logistics or delays due to transport capacity. But that's just a smokescreen. When London tells you it'll take 8 weeks to deliver physical gold, that's not a delivery issue. That's a shortage issue. There isn't enough metal to satisfy claims. The paper markets have been oversold for years, and the cracks are now visible. Think about what that means. These same institutions, COMEX, LBMA, the Bank of England, were once considered the safest and most liquid centers for gold storage. Yet now, central banks like Germany, Turkey, Poland, and Venezuela have demanded their gold back. Even emerging economies understand that if your wealth isn't under your own control, it's not really yours. These are not emotional moves. They are strategic. They know that the West's promise of convertibility is fading. We're also seeing a shift in market power. The Shanghai Metals Exchange has emerged as a direct competitor to London and New York, offering gold trading settled in yuan. That's huge. It means countries can now bypass the dollar system altogether and move physical metal directly between Asia and the Middle East. Saudi Arabia has already started building its own exchange, and Hong Kong just launched one that links straight to Shanghai. The East is preparing for a gold-backed trade network, while the West is still pretending fiat credibility hasn't collapsed. You have to ask yourself, if gold is just another commodity, why are central banks rushing to accumulate it? Why are new exchanges popping up outside the traditional financial hubs? It's simple. Because gold represents trust, and that trust is shifting eastward. When institutions like the Bank of England refuse to release physical gold to countries that request it, they're basically admitting the game's up. It's rehypothecated, leveraged, and promised to too many parties. Commercial banks are already telling their big clients to move early. That's the part retail investors miss. When sovereign wealth funds and hedge funds start converting paper positions into physical metal, you're late to the party. These deliveries are happening monthly. Millions of ounces, billions of dollars worth of gold and silver being physically withdrawn. That's not speculation. That's capital flight from paper promises to tangible assets. This is why analysts like Andy Schectman and Alistair MacLeod have been screaming about it for years. They saw this coming, the unraveling of the paper gold market. And now we're living it. The institutions that once ridiculed gold are now the ones buying it. The same Western banks that mocked physical metal investors are repatriating and accumulating it themselves. The hypocrisy is staggering, but it's also the clearest signal you'll ever get. Wall Street has always been the last to admit when it's wrong, and this time is no different. Even with gold and silver outperforming the 10-year Treasury 2-1 over the last decade, they still cling to the same outdated narratives. They mock precious metal investors as doomsday preppers, yet the data keeps proving them wrong. For 25 years, with dividends reinvested, gold has quietly beaten the S&P 500. Nobody talks about that because it shatters the illusion that paper markets are superior. The real reason for this disconnect is yield suppression. Central banks have kept real rates negative for years, forcing capital into risk assets and inflating valuations of the so-called Magnificent Seven. This isn't natural market behavior. It's artificial demand engineered through cheap money. Investors think they're chasing growth, but they're actually being herded into overpriced assets while insiders exit quietly. The big institutions aren't dumb. They're reallocating into real assets, gold, silver, commodities, while retail investors are left holding the bag. Insiders always move first. They know when the game is up, and they act long before the headlines hit. While the public is hypnotized by rising tech stocks and AI revolutions, sovereign funds and family offices are stacking metal. The same analysts who once dismissed gold as dead money are now suggesting allocations of 20 to 25%. Even BlackRock's own bond strategist, Jeffrey Gundlach, is telling clients to diversify out of bonds and into gold. When bond guys start recommending metal, you know the paradigm has shifted. Look at what's happening across major financial institutions. Morgan Stanley's chief investment officer publicly admitted that the traditional 60-40 portfolio is finished. He even advised investors to sell half their bond holdings and reallocate a fifth of their portfolios into gold. Meanwhile, Michael Hartnett at Bank of America went further, recommending a four-way split: 25% stocks, 25% bonds, 25% short-term treasuries, and 25% gold. That's not a fringe idea anymore. That's institutional risk management catching up to reality. The irony is painful. The same firms that once called gold a barbarous relic are now telling their clients to buy it. They know fiat is losing purchasing power faster than ever. They know debt levels are unsustainable. And they know that the illusion of safety in paper assets is collapsing. Yet the average investor still believes diversification within the same fiat-based system will protect them. It won't. Diversifying within paper markets doesn't eliminate systemic risk, it concentrates it. Gold and silver don't need growth stories or marketing gimmicks. They simply preserve purchasing power while everything else burns. They've outperformed even in manipulated conditions, despite central banks and bullion banks shorting the market for decades. Imagine what happens when that manipulation breaks. When physical shortages overwhelm the paper system, the revaluation will be violent. The sad part is that most retail investors will only wake up after it's too late. They'll realize too late that owning SLV or GLD was never true ownership. They'll realize the metal they thought they had was leased out, borrowed against, or simply non-existent. The entire ETF model depends on the assumption that nobody will ever ask for delivery at the same time. That assumption is breaking. This is why people like Schectman and Alistair keep repeating the same message. Get physical, stay liquid, and understand what you really own. The institutions are repositioning for a new monetary order built around hard assets. The ones who see that early will survive the transition. The ones who don't will learn the hard way what counterparty risk really means. When gold and silver suddenly crash in the middle of the night for no logical reason, most people assume it's just market volatility. But it isn't. What actually happens is far more calculated. These aren't random moves. They're deliberate, timed dumps done during the most illiquid hours, when New York is closed and Asia hasn't fully opened yet. No legitimate trader would ever unload that much metal when there's no one to take the other side. Doing so guarantees a price collapse. That's not strategy, that's sabotage. This is how the manipulation game works. They trigger sell stops, drive prices down sharply, create panic, and then buy back physical metal at discounted levels. It's not correction, it's control. It's short covering disguised as market reactions. And every time this happens, the media plays its part, spinning the same lazy headlines. Profit taking, technical pullback, or investor caution. They never ask the real question. Who's selling billions in metals when liquidity is lowest, and why? Analyst Andy Schectman calls it out directly. These moves are not the result of free market activity. They're orchestrated events meant to crush sentiment and shake out weak hands. Alistair MacLeod adds that no professional trader would risk execution like that. If you wanted to sell honestly, you'd space it out over several days, not dump everything at once. So when you see that kind of volume appear out of nowhere, understand it's not an accident, it's engineered. Now look at what happened right after those flash crashes. Banks like Morgan Stanley and Bank of America swooped in and bought physical. That's not coincidence. That's intent. They create panic in the paper market, suppress the price, and then accumulate the real stuff at a discount. It's the oldest play in the book, and yet it still works because most investors don't understand the structure of these markets. COMEX and LBMA have become tools for price control, not price discovery. This is exactly why physical delivery numbers are skyrocketing. Institutions, sovereign wealth funds, and commercial banks are taking metal off exchange every single month. They know what's coming. A supply crunch that will expose how little metal actually backs these paper contracts. Remember, for every 1 physical ounce, there are dozens of paper claims. Once confidence in those claims collapses, the whole pricing mechanism implodes. And yet, the mainstream financial press won't touch this story. They'll report on tiny CPI fluctuations or minor Fed statements, but ignore the fact that billions in gold and silver are being drained from Western vaults every month. They pretend it's irrelevant. It's not. It's the single biggest structural shift in global finance since the end of Bretton Woods. Here's the bottom line. The short attacks, the false narratives, the media silence. All of it serves one purpose: to keep you in the dark and keep you holding paper. Because the minute the public starts demanding physical, the entire leverage system falls apart. That's why they rely on ignorance and fear. They can't suppress what people refuse to sell. This isn't about trading anymore. It's about survival. The professionals know it. The central banks know it. The insiders are repositioning while the average investor is still glued to stock tickers. By the time the truth becomes mainstream, it'll be too late to react. The smart money will already be out of paper and deep into tangible assets. Andy Schectman ends his analysis with a blunt truth that most people aren't ready to hear. The biggest ongoing story in the global markets isn't inflation, interest rates, or tech stocks. It's the massive and deliberate drain of physical gold and silver from Western vaults. Month after month, billions of dollars worth of real metal are being withdrawn from COMEX and the LBMA, yet the financial media stays silent. They call price drops corrections and claim demand is softening. But the data proves the opposite. Deliveries are soaring. Inventories are vanishing. What's really happening is that the world is de-dollarizing faster than anyone in the mainstream will admit. Central banks and sovereign funds are quietly repositioning into real money, not promises. The West built its financial empire on paper, ETFs, derivatives, and debt. But the East is rebuilding the foundation on metal. Every ounce leaving Western custody is another crack in that system. The journalists who ignore this aren't just lazy. They're complicit in hiding the truth from ordinary investors. When these institutions dump billions in precious metals during illiquid hours, it's not market correction. It's panic creation. It's short covering dressed up as volatility. They need those price dips to refill their vaults before the next leg up. This is how control is maintained, through fear, confusion, and manipulation. But every manipulation leaves a trail, and that trail shows one undeniable trend. The physical market is tightening while paper markets crumble under their own lies. So where does that leave you? It means the time for trusting paper claims is over. This isn't about chasing returns or trying to time the next rally. It's about protecting purchasing power in a collapsing system. Holding physical silver and gold isn't a trade. It's insurance against monetary decay. It's about ownership, real, tangible, and untouchable. Every ounce in your hand is one less weapon they can use against you. When yield chasing stops working and the 60-40 portfolio finally dies, the world will relearn what real value looks like. Those who hold metals will stand outside the chaos, while everyone else scrambles to exit paper markets that no longer redeem anything. That's why Andy Schectman, Alistair MacLeod, and countless veteran analysts keep repeating one message. Before the music stops, make sure you're holding something real. You can't trust institutions that profit from manipulation. You can't depend on a system that punishes savers and rewards debt. And you definitely can't assume the media will warn you when the floor gives out. You have to see it for yourself and act before everyone else does. If this breakdown helped you see through the noise, hit the like button, share it with other investors who need to wake up, and don't forget to subscribe to Gold Rush Reporter. I'm your silver analyst, and I'll keep bringing you the truth about what's really happening in the metals market. No spin, no hype, just facts. Stay vigilant, stay liquid, and stay prepared. Because the era of paper promises is ending, and the era of real assets is just beginning.